Welcome to our High Rock monthly video for July. I am Scott Tomlinson, and with me on the call is the founder of High Rock and the portfolio manager. If you would like to learn more about us, please visit our website at www.highrockcapital.ca. So let's talk a little bit about the month of June, Paul. Wishing everybody a happy Canada Day, because that was basically what happened at the end of June. We got Canada Day, and hope everybody had a lovely weekend. In the financial markets, June was a very good month for the US equity markets, and we'll talk a little bit about that as we move through the video today. Generally, global equity, Canadian bonds were positive. Balanced portfolios were pretty flat all in. So were Canadian preferred shares, and then REITs, gold, and Canadian equities were a little soft. I don't know if you have anything to comment here, Paul.
Well, just the obvious. US equities really outperforming everything else in the world, and I think you're going to talk a bit more about that sort of lack of breadth in the market, if you will.
Yes, we'll definitely get to that momentarily. We are halfway through the year, so let's look at what has transpired over the course of the year. Gold, silver still leading, even though they've come off their highs. As we talked about, U.S. equities, and we'll talk more about that. Canadian preferred shares, certainly Paul will talk a little bit more about that, because our mandate, our preferred share mandate that we began last November has done quite well, as well as some of the overweight in our balance mandates. So that's been good. Global equities, balanced portfolios in general have done reasonably well, and we'll talk a little bit more about that in a second. The laggers this year have been Canadian bonds and Canadian real estate investment trusts. But I don't think there's any more to talk about there, Paul. Just let's move to what we look at as for comparison purposes. We look at Morningstar's balance category. So Morningstar, on an average of some 1,500 funds, sees that the averages over the course of this year thus far, in the first half, have been up about 585 over the year to last June, up 11.5. The 3-year, of course, with the difficult year in 2022, up about 2.5. 5 years, up about 4.5. So these are numbers that you can look at your own portfolio performance and make comparisons. And then when you have questions about your relative performance compared to these, please definitely give us a call, and we're more than happy to chat about that. We also want to chat about what we do for you as far as managing your risk relative to the returns that you're getting. So that's another thing that we can talk about individually with each of our clients, and please feel free to engage us to do so whenever it is that you wish. Paul, we have a couple of high yield and preferred share mandates. Do you want to talk about these?
Yeah, we'll keep it pretty briefly, starting with the high yield mandate. Not a lot of activity. Again, I go back to what I've said in previous video recordings and to those investors directly that are in the high yield mandate. It's going to be more of a coupon year. This year meaning that we're going to collect our interest income from the coupons the bonds pay every 6 months. Not as sexy, and the reason being is that we had a huge overweight the last 4 years in energy bonds. Some of them were very distressed levels, trading down at 20, 30, 40 cents the dollar 4 years ago, that are now at par, 100 cents the dollar. So that there were a lot of capital gains in that portfolio. So moving forward, a lot more stability, which is always something we strive for in a high yield mandate. Preferred shares, that mandate, which Scott, you mentioned, began for most of our investors in that mandate was kind of early November, some a little bit later. That's worked out extremely well. A lot of corporate issuers, non-financial or non-bank, non-insurance company issuers, their preferred shares just got absolutely annihilated beginning last August in through to October. That was sort of the bottom. We weren't quite able to get the bottom just due to logistics when investors came into the mandate, but we certainly have done extremely well 7 months in or so, 8 months in. And well, then I will comment more on preferred, Scott, when we talk about our fixed income model. How's that?
Okay. I do have the slides in order here, so I don't know if you maybe feel like you want to do that now, and we'll just avoid.
Then I will. So one of the when we started this pref mandate idea, really started getting interested in it and finding the market was getting very dislocated as it did in 2017, the summer of 2017, in fact, was August last summer, August 2023. And then by November, we picked up on a theme with another office mate that we felt like the banks were going to, they have these 5-year rate reset preferreds. So every 5 years, the bank, 30 days before the date, the 5-year date, they either have to state whether they're going to extend for another 5 years on that preferred share or redeem it. And our call and our view, for multiple reasons, was that the banks were going to redeem their preferreds on these upcoming 2024 and into 2025 reset dates. So as you can see here, this is TD.PF.B, which we no longer own, and I'll explain why. In the bottom left, we bought it in November 2024 last year, around $18.50, as you can see, and we had the right call. We wrote it up, and we sold them before redemption, but the redemption was announced, and we sold it a few days later at $25.10. Plus, we collected 2 dividends on the way for worth 46 cents. So the total return on that trade from November 2023, there's a mistake in there on dates, and into June 2024 was 38%. If you look at that on an annualized basis, that was a 69% return. So that was a phenomenal trade. We freed up the cash, and we'll look at reinvesting. Now, this is quite frankly, in our preferred share mandate as well as our balance mandate. In our balance mandate, this was a big overweight position that, along with a couple others. So we still have 3. So Scott, maybe go to the next slide. So the other one was a much shorter trade. It was only a month long. We bought it May 14th and sold it June 26th. So I'll call it almost 6 weeks. So that was only a 4.6 return, but again, it was what we felt at the time, and we were correct, it was a very, very low risk trade. So 4.6 return doesn't sound like a lot, but that happened over 6 weeks. If you look at it on an annualized basis, that's 47% annualized return. So that too, we sold to a dealer and went into cash. So we still have 2 bank preferreds in both our pref mandate and in our balance mandate. So we are still a little bit overweight. We had a big overweight position in prefs, but these 2 sales, TD and CIBC, have now left us with a slight overweight position. One is a BMO matures in November, or comes up for redemption in November. And the other one is yet another CIBC that comes in January. So that'll be in the back half of the year, really. We should hear on certainly the BMO, but we could hear on the CIBC one as well. And I won't go into the details. If anyone's interested and you want to learn more about or inquire about why this is happening, I'm happy to take a phone call or an email from anybody. But that's our position both in balanced mandates and in the preferred mandate. with regards to prefs.
All right. Well, thanks, Paul, for that, and congratulations on finding this incredible value that you were able to unleash for our clients. Because I think this is what we do that adds value to our client portfolios. We can just have a basket of bonds and a basket of equities and run a balanced mandate. But when we hunt for good value in the market and find these opportunities, they don't come up all the time. So we're always looking for opportunities, but it may be a little while before the next one comes along. But it's great that you were able to find this and take advantage of it, and much to the benefit of our clients.
Thanks, Scott.
As we repeat on a regular basis, at least once a month anyways, we're always looking at our clients' long-term goals. Certainly, we want to achieve short-term returns like you've just been able to do, because that adds value and it helps the long-term returns. So that's a great thing. But again, it's about long-term goals and long-term planning. And of course, it's important that our clients continue to lean on us to update their outlooks, their goals, and to make sure that we're on the right track. Let's talk a little bit about our global equity strategy. As we mentioned, what's been happening in the world of equities, we've seen basically US large cap equities, the S&P 500 index ETF has really been leading the charge in global equities. A little bit of added value if you own them in Canadian dollar terms because of the relative weakness of the Canadian dollar. So you get a bit of an extra whammy over when you own them in US dollars. NASDAQ as well, from a technology perspective, has been driving US equities. Farther down, we've seen a bounce back in emerging economy equity ETF this year. So that's added a little extra value to our global equity model. The laggards have been small companies both in the US and small companies globally. And that is something that Paul mentioned before. When large companies seem to have captured a large degree of the up move, while small companies have basically been flat for the first half of this year, there is definitely something that we have to recognize, and that is that the market breadth is narrowing and widening, and really what's happening, if you look at the S&P 500, is that there are 7 companies that account for almost 40% of the value of the S&P 500, and those 7 companies are driving that particular index. So there is lots of risk insofar as if those companies should start to falter, that will put some significant downward pressure on the S&P 500. And that's something we are taking note of. What we're doing strategically is when we need to rebalance, if to raise cash or a client portfolio is overweight in any of these outperforming assets, then we're taking sales in these ETFs that have done so well, taking our profits and then looking for either value in underperforming assets or sitting in cash temporarily until we do get some value. So that's the strategy that we've been taking with the global equity portfolio, monitoring how little breadth there has been over the course of this year so far. Paul, do you want to talk about the tactical model?
Yeah. The only real position change or trade we did, and I'll reiterate, we sold our position, which was what our largest tactical position, which was in Source Energy bonds. This was a large coupon bond. We bought it at very distressed levels. We considered it equity, not fixed income, even though it was a bond. But we probably owned it, depending on the investor, but around an average of about 40 odd cents in the dollar. And it paid huge coupon interest for 2.5 years or so that we owned it. So, and we sold it out at par over a month ago. And then we bought that company, Source Energy, which is a sand fracking miner and provider of the sand and the logistics that goes down the pipe into fracking that breaks up all the sedimentary rock to release the gas and the oil. We bought the stock, and the bond that we owned matures in March 2025. And I think there were a pile of hedge funds that were all along the stock. They drove from $4 to $18 only back in May, got up to like 18 and change. And then we ended up buying it. We probably own it for most of our clients anyway, around $9.90. I'm happy to report that today it's up, trading around $11.75, which is up about 18% since we've owned it the past month. So I'm pleased with that, obviously. I think this stock, and I won't go into a lot of valuation detail, but I know the company well. I'm in touch with the CFO a lot. And there's another office mate who has done a lot of research on this as well, and I know he owns a position too. So I'm able to share some intel with him. But we ended up buying this company at below 3 times EBITDA, and a competitor in the US, now a much larger company, was bought out, privatized by Apollo, a private equity firm, at 5 times EBITDA. We bought this thing under 3 times EBITDA, just to give you an idea. At even 3.5 times EBITDA, this stock would be at $15. At 5 times EBITDA, if it got there, it would be at $28. So we're trading at $11.75 right now. But I think at a minimum, we're going to be up around $15 here. This bond will get, some people are nervous about it not being refinanced. I think it'll be refinanced very easily. So that's sort of the MO there. And then away from that, I would just make a comment that the bank, obviously, Bank of Canada has cut rates once. We'll find out what the Fed does this month, but I don't think rates are going higher. That's probably a pretty safe assumption. So some of these dividend-paying stocks that we own in the tactical model, and they're not huge positions for most clients. Some they are much larger, but these are big dividend paying stocks now at this stage, and some of them are blue chip, some not. But like a BCE, we're at 9.30 dividend yield, Enbridge 7.5, TransCanada 7.5, like Yellow Media, which is a declining revenue business for sure, but it's almost at 11%. It was at 11%. It's tracked up a little bit now, the stock, but as rates, if as and when the bank does cut rates more, these dividends paying stocks should find a really good base. So that's something for us to consider, even though they are not big growth companies at all. But they all, even Yellow Media, they've all have been increasing their dividend. So they have they're blue chip companies, they have stable cash flow. And as rates come off and you're looking at, Bill Canada at 9+% dividend yield, I got to think it's going to find a base. So that's something to consider. That's it for tactical, Scott.
Excellent. Thanks, Paul. You talked about preferred shares. Anything to add in the fixed income strategy model?
Yeah, not a lot within fixed income. We had a couple bonds, high yield bonds that were upgraded into the investment grade piece of the pie. Ford, which was a few months ago, that's now investment grade, and then which we sold, Quebecor Videotron is now investment grade as well. But we did sell that bond to raise a bit of cash for more preferred shares. So again, preferred shares, we still have an overweight. It's not as big. I can tell you here. We're only about 3 to 4% overweight preferred shares right now for most clients. and some of that will be gone hopefully by the end of the year. As you said, that's been a very, I know it's in the fixed income model, but a very tactical trade where we try to add value. And if people look at their performance against the Morningstar performance, some of that performance is really driven by both US stock exposure and these preferred shares. So, yeah.
Excellent. Okay. Well, that is all for our three models and our balance mandates and our special mandates. We do sponsor, High Rock sponsors a couple of athletes who have some interesting events coming up in July. Finn Gilbert, a young hockey player, AAA, U16. So this is his junior draft year. He's going to be showcased down in the Chowder Cup in Boston at the end of the month. And then Miranda Tomlinson, our High Rock sponsored triathlete, continues on her professional series circuit with a race in Maine at the end of July. So just a couple of updates on our High Rock sponsored athletes. So as always, we want to thank you for taking the time out of your busy schedules to tune in. We'll be back with our next update at the beginning of August. So until then, I'm Scott Tomlinson, and on behalf of my colleagues Paul and Diane, we want to wish you all the best for the month of July.